Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Welcome to this video. Today we're talking about why thermal coal is not invested in and why capital is sitting on the sidelines. We'll break down what changed and what investors are watching right now. If you've noticed more headlines about investors avoiding coal, you're not imagining it. In January, thermal coal, the type of coal burned to make electricity, sits in a tougher spot than it did a few years ago, even after periods of strong prices. When people say thermal coal is not invested in, they usually mean something practical, not mysterious. Many large funds, banks, insurers, and even individual investors are choosing not to add new exposure, or they're limiting it to short-term trades. Some still hold legacy positions, but they aren't eager buyers. Three forces sit behind this shift. Policy pressure that raises costs and uncertainty. Financial risk tied to shrinking financing options. Cleaner power sources that keep getting cheaper and easier to build. What changed that makes thermal coal harder to invest in? Thermal coal can still generate cash in the right conditions, but the path from strong demand to investable asset has narrowed. Investors care about what can hit returns fast. Rising operating costs. Unpredictable rules. Limits on financing. The big change is that coal is no longer judged only on commodity price. It's judged on whether it can keep operating, keep selling, and keep accessing capital. That adds layers of risk that don't show up in a simple price chart. Some investors compare it to owning a rental house in an area with unstable zoning. The building may look fine today, but the rulebook can change before you recover your money. Coal markets also swing hard, which makes long-term planning difficult for miners, utilities, and their shareholders. Tighter rules and higher costs, from emissions limits to carbon pricing. Thermal coal faces more compliance requirements than many other fuels. Air pollution limits, climate targets, water rules, and land use permitting can all add cost. The details vary by country, state, and even local district, but the uncertainty itself is a risk investors price in. These rules can hit profits in plain ways. A coal plant might need new equipment for sulfur, nitrogen oxides, or particulate controls. A mine might face stricter methane rules or more costly reclamation bonds. Each upgrade takes time and capital, and it can lower margins even when coal prices look healthy. Carbon pricing, where it exists, adds another layer. If emitting CO carries a fee, a coal generator can become less competitive overnight. Even where carbon pricing isn't in place, investors worry about policy catch-up, meaning a future rule that changes the math midstream. The sharp end of this is early closure. A plant designed for a long run might face a retirement decision much sooner because the cost to stay compliant no longer pencils out. Financing is shrinking as banks and insurers step back. Coal investment is also squeezed by the funding side. Many lenders now have restricted lending policies. Some banks won't fund coal projects at all, while others will only lend under strict conditions. Shorter timelines. Higher rates. More collateral. Tighter covenants. That wraps up part 1. We've covered why thermal coal has become harder to invest in and the main risks investors see today. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.